What happens to your 401k if the United States completely loses its pristine credit rating? The short answer: you might be running up a down escalator just to stay in the same place. Honestly, the real danger isn't that the US goes bankrupt tomorrow, it's a phantom tax that eats your savings from the inside out. My name is Bob, and we need to talk about what a government downgrade actually does to your stocks, your bonds, and your real-world purchasing power. Asterisk, you're sitting at your kitchen table on a random Tuesday night. The dinner dishes are done, the house is quiet, and you decide to log into your retirement account just to check on things. You type in your password, look at that total balance number, and feel a small, quiet sense of relief. It's growing. It's not a fortune yet, but it's real money. It represents every early morning, every stressful meeting, and every time you chose to save rather than spend. It's your safety net. It is your ticket to a future where you don't have to punch a clock anymore. But then, you close the tab, open up a news site, and see a flashing headline that reads, "Major Rating Agency Downgrades United States Credit Rating." But honestly, your first instinct is probably to blink, shrug, and keep scrolling. It sounds like pure, unadulterated political theater, the kind of dry, macroeconomic jargon that talking heads on cable news scream about to fill airtime. It feels completely detached from your real, day-to-day life. My name's Bob, and I spend way too much time thinking about money, financial psychology, and why some people seem to effortlessly build wealth while others stay stuck in the same anxious patterns for decades. And one thing I've noticed is that we are incredibly good at compartmentalizing financial risks. We worry about our monthly cell phone bill, but we completely ignore the massive tectonic shifts happening right under our feet. Because here's the uncomfortable truth. If the United States completely loses its pristine credit rating, an invisible domino effect triggers. It starts in Washington, ripples through Wall Street, and ends right inside your 401k. It's a quiet shift that can fundamentally alter how your retirement savings grow, how much your investments are worth, and how long you might have to keep working. By the time we finish this conversation, you're not just going to understand what a credit downgrade means on paper. You're going to understand exactly how it alters the DNA of your stocks, your bonds, and your purchasing power. More importantly, you will know how to look at your portfolio not with panic, but with a practical, clear-eyed strategy to protect what's yours. Basically, to understand why a credit rating matters, we have to look at what the US government actually is. To the global financial system, it is the world's ultimate power. When the government spends more money than it brings in through taxes, which it does constantly, it issues US treasuries. These are essentially IOUs. For decades, these IOUs have been viewed as the safest financial asset on the planet. They are the risk-free rate of return. When a credit agency like S&P, Fitch, or Moody's cuts that rating, they aren't saying the US is going bankrupt tomorrow. They are saying, hey, the math isn't matching up anymore. The political gridlock is too severe. The debt is too high. And the risk, even if it's microscopic, is rising. Think of it like a personal credit score. If you have an 820 credit score, banks beg you to take their money at the lowest possible interest rates. If your score drops to 650, you can still borrow money. But it's going to cost you a lot more. When the US gets downgraded, global investors start demanding a higher interest rate to lend America money, because the US bond market acts as the foundational bedrock for the entire global economy. When that bedrock shifts, everything built on top of it starts to shake. If you look at a standard Target 8 fund or a balanced 401k portfolio, you'll find a significant chunk dedicated to bonds. We are taught that bonds are the safe part of our portfolio. They are the shock absorbers, meant to cushion the blow when the stock market goes into a tailspin. But a credit rating downgrade flips that script in a really weird, counterintuitive way. There is an inverse bond law, where when interest rates and yields go up, bond prices go down. They move on a playground, seesaw.f. The US credit rating drops. The yield on government bonds resizes because investors demand more yield for the added risk. If new bonds are being issued at a higher interest rate, the older bonds sitting inside your 401k mutual funds suddenly look incredibly unattractive. Why would an investor buy your older bond paying 3% when they can buy a brand new one paying 5%? To sell those older bonds, their underlying value has to drop. If you look at your 401k during a major rating downgrade event, you might see something truly bizarre. Your stock funds are dropping, and your safe bond funds are dropping right alongside them. The shock absorber is suddenly broken. It's easy to think that a government credit issue is just a government problem. You might assume that great blue-chip American companies will keep chugging along, making iPhones, selling sneakers, and delivering packages regardless of what happens to Washington's credit score. Unfortunately, finance has a concept known as the sovereign ceiling. Basically, a corporation is almost never allowed to have a higher credit rating than the government of the country it calls home. If the United States credit rating gets chopped down, companies like Microsoft, Apple, or Johnson & Johnson are often automatically downgraded to or at least see their borrowing outlook worsened. When corporate credit ratings fall, it becomes more expensive for those businesses to borrow money to build new factories, hire workers, or fund research and development. Imagine you run a massive business and your interest expense suddenly jumps by tens of millions of dollars a year. That is pure profit leaking out of the boat. For your 401k, lower corporate profits mean lower stock prices. It turns a macroeconomic headline into a direct hit to your equity funds. Let's wander into a quick aside here, because we need to talk about how governments actually handle debt. When a regular person borrows too much money, they have two choices: default and go bankrupt, or cut back on eating out and work extra hours to pay it off. But governments have a third option that you and I don't have. They can print the currency that the debt is owed, and if the U.S. loses its credit rating and investors stop wanting to buy our debt, the Federal Reserve can step in as the buyer of last resort. They can effectively create new dollars to buy government bonds. What happens when you flood the economy with more dollars? The value of every individual dollar you have saved shrinks. It's inflation. The credit downgrade leads to lower foreign demand for bonds, which leads to potential currency printing. And that ultimately leads to purchasing power loss. This is the phantom tax on your 401k. Your account balance might stay exactly the same on your screen, but the actual purchasing power of those numbers is eroding. If your 401k grows by 5% in a year, but a credit-induced wave of inflation runs at 6%, you didn't actually build wealth. You've lost ground. You're running up a down escalator. When a credit rating downgrade hits the wire, the immediate reaction on Wall Street is almost always a chaotic, emotional temper tantrum. We saw glimpses of this in 2011 when Standard & Poor's stripped us of its perfect AAA rating for the first time in history. The stock market tanked by several percentage points in a single day, and the VIX, the stock market's fear index, went absolutely parabolic. This is where the psychological trap springs shut on everyday investors. You log into your 401k, see thousands of dollars wiped out in a week, and your brain screams at you to do something. It triggers that ancient, primal fight or flight response. Honestly, the biggest danger to your 401k during a credit crisis isn't actually the rating agency. It's the person looking back at you in the mirror. When people panic sell their retirement funds at the bottom of a market drop, they lock in their losses. They turn paper losses into permanent, real-world financial damage. The market almost always recovers eventually, but if you ran for the exodus, you missed the ride back up. For nearly a century, the U.S. dollar has been the undisputed king of global trade. Commodities like oil are priced in dollars. Central banks around the world hold massive reserves of greenbacks as a safety net. This status gives America a massive economic superpower. We can run up huge debts because the rest of the world constantly needs our currency. A lost credit rating chips away at that foundation. It sends a signal to the rest of the world that the king might be getting sloppy. If global central banks decide to diversify away from the dollar and move toward other assets, the structural demand for the dollar falls. For your 401k, this means you need to start looking past the borders of the United States. If your entire retirement is invested solely in domestic U.S. stocks and bonds, you are completely exposed to single-country risk. International diversification isn't just a luxury anymore. It becomes a fundamental shield to protect your long-term wealth. So, knowing all of this, what do you actually do? You don't pull all your money out of the market and bury cash in mason jars in your backyard. That's a guaranteed way to let inflation eat your future alive. Instead, you make intentional, strategic adjustments.